Welcome to the What to Watch video update. This is a video that I do at least once a week, and so far since I've been doing it, it's only been once a week, where I go through and I really pick out the things that I'm focused on right now. Because I do a lot of videos each week. I do a video each day, I do a weekly video, I do an intermarket analysis video, I do a deep dive video where I cover the charts that maybe aren't speaking really loudly to us right now. So we have to really look deep to find something. And then this is the final video that I do over the weekend to really pick out the things that are both positive and negative and areas that I'm going to be watching over the upcoming week. The idea is that I may update this at times, but I haven't done that since I've been doing this video. So it's kind of developed into a weekly video. This is being prepared for Monday, June 24th. Now, before I get started, I do have a program. It's called the SPX Investing Program. It launched at the beginning of June. Feel free to check that out. Now, there's not an awful lot there, but I'll be adding more things as we go along. It's free for the month of June. I will be locking it down in July, as I have a lot of things that I don't necessarily share publicly that'll be available in the program itself. If you want to learn more about the program or go to the actual website, there are links below this video and every video that I post. If you want to talk to me about this, here is an email address where you can contact me. Maybe you have some questions. You might want to set up a time to talk about things. So I'll just leave that up to you. The first area that I'll go through are the positive things. And we really have quite a long list, but there's a fine line between what's positive and what could easily switch over to negative, just like some of the negative things could switch over and look positive. We'll have to see how things play out. I'm just going with how they look right now and in the context that I'll point out. We first look at the trend, and to me, this is my most primary indicator. This is called the ADX, or average directional movement. That's the black line that you see going through here, the dark black line. What I do is I put a moving average on top of this just to give it a little bit of context to see, well, is it going up or is it going down? If it's going up, that means it's a strengthening trend. If it's going down, that means it's a weakening trend, but still a trend. Then we use static numbers of 20. When we're below 20, that means we're not trending. When we go above 40, that typically means that we're overextended in the trend and not necessarily due for a reversal, but due for a slowing down of the market. Well, right now, we are above the moving average, so that's a strengthening trend, and we're above 20. So this is a confirmed trend. Now, to determine is it positive or negative, we look for the green and red line. The green line is on top, so that's positive, but the green line has been coming down. For this to be even more positive, we want to see the ADX continue to go up above the moving average and the green line turn and start to go back up as well. That would be the best indication that we're looking more positive. We also keep a really close eye on the VIX, where we're still not seeing an awful lot of fear in the market. It's up from these lower levels that we have been seeing, but it ticked down a little bit in Friday's session, both on a closing basis. We also closed near the lower end of the bar and below these moving averages, just showing that there's not a lot of fear in the market. We also look at the VIX of the VIX. So this measures the volatility of the VIX, and it was starting to pick back up, at least on the bar charts. We're seeing a series of higher highs and a few lower highs right here, lower lows, higher lows. That's what I was trying to say. But we did end up coming down a little bit in Friday's session. So this is showing that the volatility of the VIX is picking up just a little bit. So that just means the VIX might have a chance of doing more moving. Typically on an up day, we'll see the VIX of the VIX go down. On a down day, we'll see it go up. But we really focus on the VIX itself. This is a study put out by Tom Bowley, who's connected with stockcharts.com. He's also connected with another site called earningsbeats.com. I am a subscriber to stockcharts.com, which is where I found this chart. I don't subscribe to earningsbeats.com, but I do get their emails. And what he found out is when we get a really low reading of the VIX, and this is a weekly chart of the VIX, which is up to date. Now, these numbers were done about October-ish or so of 2023, but they're still quite valid. The lower the VIX goes, you probably heard the term, when the VIX is low, it's time to go. When the VIX is high, it's time to buy. Well, yeah, it can get to a low reading, but this is where we see the strongest annualized returns. That's when the stock market is generally doing well. And it doesn't mean we're going to get down to this level and immediately turn and go the other way. We've been getting rather low VIX readings for much of 2024, even going back into 2023. Now, we're just a little above 13. We closed at 13.2 right now. So we're kind of right on the border between this dark green area and this lighter green area, where both of these produce pretty good annualized returns, but they really drop off as the VIX goes up. It almost cuts in half when we get up here into this yellow area. Where it turns negative is when the VIX starts to go above 20. That's when we see negative annualized returns. So right now, this is still looking positive. We're looking at the momentum of the VIX, though, as measured by the MACD. And the VIX has been going back up lately. This is what I was trying to talk about, with a series of higher highs and higher lows. And so the MACD is picking that up, and we're seeing the general momentum of the VIX starting to go back up. That could be a little bit of a concern, but we're still getting a very low reading at 13.2. We're seeing some negative things and some positive things here. This is the advanced decline line study. When we look at this based on price, this is the negative side. Even though we're improving and it's starting to come back up, as the S&P was setting a new all-time high, we have not surpassed the previous high here based on price. So that's the negative part. The positive part is, even though the advanced decline line has been struggling a little bit, we're still holding up fairly well and a little bit above this breakout point when we measure this based on volume. So that's the positive side of this chart. So there's a takeaway from each side here. We look at the new highs, new lows, not really showing an awful lot of strength, but not showing an awful lot of weakness either. We are seeing a contraction of the new highs, not really an expansion of the new lows. So our 5-day moving average is going sideways. We're seeing a little bit of an improvement, but almost flat still with the 10-period moving average. So for right now, we would default to positive since there's a lot more green than there is red. What we want to see is this to really continue to expand and see both of these moving averages turn up. If we turn more negative, we'll probably see the green really continue to contract and possibly an expansion of the red. Accumulation distribution. This is a smart money indicator. And one of the concerns I was having is that we might have been getting a little far away from this red line, which is a moving average. We're coming back down a little bit here. Maybe we did get kind of far away and we're kind of pulling back or reverting back to the mean, so to speak. Well, this is still positive, though, since we're above the red line and the red line is going up. We want to watch this and see, especially if we have an up day. If this continues to go down, that could be very telling. If we continue to go up with this, that just means the smart money is in there doing more buying. Then we were negative with this. This is the advanced decline ratio on a short-term basis based on 19 periods and 39 periods, more intermediate term. We were below zero a week ago. We've been showing some improvement, and now both the blue line and the red line are back above zero. So that's showing a little bit of an improvement there. This is also improving. This is that same 19-day advanced decline ratio where the previous chart just looks at it based on price, and we're above zero. So that's turning back to more positive. Where we're looking a little better too is we're above zero here based on volume. So this together is showing a little bit of an improvement. This is the chicken money flow, another smart money indicator where this has been going up. Now we are coming down a little bit after we again have been getting a really high reading with the chicken money flow. We're wondering, is this just a pullback before it gets set to go back up, or are we going to start to see this continue to decline? For right now, it's positive. But since the red line is starting to go down, that is giving us a warning sign. We eventually want to see the moving average, the red line, turn and go back up. The chicken oscillator, after giving us an extreme positive reading, is now dropping back down. It's no longer extreme, but now it's declining. However, it's still positive because we are above zero. Then I have some intraday charts where I'm measuring growth versus value. Growth is blue, and that's outperforming the red line, which is value. And we've been seeing that now for a while. And this is showing a real improvement. When the market really gets set to go higher, we see the blue line above the red line typically. There are some exceptions here. And we look at another ratio between growth to value for the S&P on a 10-minute intraday chart. Since the beginning of June, we've been seeing this really going up, and it's been improving quite a bit. Then we started to level off and actually declining just a little bit here over the last week. Now, this is still positive, but if we start to see this continue to drop down, it could turn negative pretty quickly. We break this down a little bit more. We look at the small caps, which have not been a well-performing area thus far in 2024. We're looking good. Last December, we hit a high end of the range and then a low end of the range, and we've been in that range now for, well, here it is June, and this is going back to January when this was happening. So we're looking okay here with the growth to value ratio with the small caps, but we're not breaking out right now. It just shows that there's not a lot of strength in the small caps. And we're seeing a little bit of an improvement here with the mid cap growth to value ratio, but it's not breaking out either. And earlier on, the mid caps, they were really starting to break out right at the end of January, going up into about the first part of April. Then they pulled back, and then we saw some more strength about halfway through April, going into the middle part or so of May. Well, we're not seeing that now. As the S&P has been going up, the mid caps aren't really taking part. For a while back in January, February, and then back in April and into May, this was the strongest index, but it's not the strongest index right now. It would be nice if they were coming along for the ride. That just means that there's more broad market participation. And so as this was going down, we actually saw a death cross here with this growth to value ratio. And that's a bit of a concern. If we can stay above both of these lines and start to go up, eventually seeing a golden cross with this ratio, that would turn it more positive. The reason why these charts are on the positive side is because of this, the growth to value ratio for the S&P 500. We finally broke out above these previous highs. Even though we have been coming down over the last session or two, we are still holding up, and we want to see this ratio continue to go up to be more positive on the S&P. We also look at a couple of ETFs, a growth versus a value ETF. And this, even though it's turning down right now, is still above the rainbow, and it shows that growth is outperforming value. Discretionary, which hasn't been doing all that great, it's been chopping sideways when we look at it by itself. The reason why this ratio has been improving on the bottom is because staples have been seeing some weakness. We want to see this really going up, and it is, but it's not breaking out, and it's not really showing any strength. It's more that it's showing the weakness that we've been seeing in staples. And we look at some other growth to value ratios. The Qs to the S&P, it's coming down, but still above an advancing moving average. This is the disappointing part. Discretionary to the S&P, it's turning up and crossing above its moving average, but the moving average is still declining. And a lot of this has to do with sluggishness we've been seeing in Tesla. We are seeing where large cap growth is outperforming large cap value, but it did pull back. However, the moving average is still going up. So when we look at the large caps, yeah, we're coming down, but the moving average is going up. We're starting to turn up with the mid caps, but we're seeing a little bit of a turn down here. We're seeing pretty much that same thing with the small caps. It's coming down, but the moving average is now starting to go up. So there are signs of improvement, but the market needs to build on this. Then we look at a double and triple exponential moving average study based on 20 periods. The lines are still going up, and we're kind of in between both of these lines right here. So until we actually break below this and close below it, I'm counting that as positive. That's short term. Now, intermediate term, we look at a double and triple exponential moving average based on 50 periods, and we're still above both the red line and the blue line. And as long as we stay above this, the intermediate term trend, according to this chart, will still remain positive. If we break down below it, that will be more negative. Another positive thing we see happening here is back in November when the red line crossed above the blue line, that's when we really were going up with a vengeance. We're seeing the red line starting to cross above the blue line here. So that could be something in development that could be positive. But if we start to break down below this with price, then that's going to turn this more negative. Here's a regular 20-period moving average study. I use both a simple moving average and an exponential moving average. We're above both of them right now. If we start to fall down, we will be watching one of these lines, probably the simple, since that's what most people use. We'll be seeing if that ends up providing some support. If we continue to go up, then these lines will just continue to go up as well. Here's a bunch of different moving averages, both simple and exponential moving averages. for the 20, 50, 100, and 200. And we're above all of these moving averages. So that in and of itself is positive. We're seeing an improvement here. A week ago, this was looking more negative. The 20-period moving average is starting to turn up. Now, this is the moving average of the S&P itself. We're not looking at the internal things inside the S&P. This is just measuring the price action of the S&P. So the 20 is looking better. The 50 is improving, even though it was flat on Friday. And we're seeing a little bit of an improvement with the 200 period, but we did go flat on Friday. This is also, it's kind of the borderline between a primary and a secondary indicator. This is the Swenlin trading oscillator. We were looking more negative, but now we're starting to turn back and look positive. We were below zero based on price. We were crossed back above it. That's positive. We were also below zero, and we just barely crossed back above zero based on volume. We're going sideways right now, but the fact that it's slightly positive, we can take that as both of these being positive for right now. We keep an eye on the cumulative advanced decline line for the NYSE. The reason this is positive, even though it's declining, we're still above this moving average. Down below, we have a regular NYSE advanced decline line, also still above its moving average. We see that confirmed by a different NYSE advanced decline line, which is calculated a little bit differently. It's also above this 50-day moving average. So this means that it's holding to this point. We look at the advanced decline line for common stock on the NYSE based on price, where it bounced up just a little bit after it had been declining. We're seeing a little bit of a bounce up here with volume as well. And it didn't decline quite as much. You can see if you look at from the top down to the bottom, that's more based on price than if the top to the bottom based on volume. That could be a positive divergence. But I've picked these things out before and they ended up not leading to anything. Other times I picked these things out and it led to something. This is kind of a big deal. This is a weekly chart of the S&P 500. And if you've been watching these videos for a while, I was just harping on this R1 level here for a long, long time. Well, we finally broke above that and I was able to make this chart go away for a bit. Now we're getting up to the R2 level. Now, this is quite positive unless we lose this R2 level, because this is a weekly chart. So that means that this bar is good for the whole week. We were able to get above that and then close above it. We closed at 54.64, about 54.65. This reading here is at 54.51. So we're just a little bit above this R2 level. Can that hold? Other times we came right up to this pivot point and then turned, right up to this pivot point and turned. The fact that we're above it, that's positive, but we want to make sure we can actually hold on to this level. This is a longer term. Right now, it's hard to call it a support level since we're just barely above it. But the fact that we crossed above it means that we are potentially breaking resistance. Then this is also an improvement. The stocks inside the S&P above their 20-period moving averages. This had been negative. This is still giving us a negative divergence. We were going up with the S&P while this is still lagging behind, but this is turning back positive. I count it as positive when we cross back above 50. Then we also have a 20-period moving average study where we came down and gave a very negative reading, and then not too long after that shot up and gave a very positive reading. Well, back in 2023 of March, we saw that same thing. We got a negative reading, it shot up. We chopped around a little bit sideways. We actually went down and we're not looking all that positive for a while, kind of similar to what we've been seeing lately. But then after that, we saw another up thrust, and that really helped the S&P itself to go up. We're wondering if that's going to happen again this time. Then the stocks above their 50-period moving average, it had been negative. Now we're crossing back above 50. So this is turning back positive. We're also crossing back above 50 with the 100-period moving average steady. And we're turning back up with the 200-period moving average steady. So this is showing a little bit of internal strength in the S&P itself. The S&P McClellan oscillator, still a negative divergence right here, but we have crossed above zero. That's somewhat positive. So we're starting to possibly at least level out, if not turn up, with the summation index based on price. We're still going down, but at least slowing down a little bit here based on volume. For these to turn back up would turn things more positive. One thing to just tell you about, the top indicator here and the bottom indicator, there are two completely different indicators, and they're calculated completely different. You might see that as positive or negative. I see it as kind of a cool thing because since they're two different indicators, we can tend to rely on their confirmation a little bit more. But we want to see both of these lines start to go back up if we're going to stay positive. The staples to tech ratio, when this is going down, that means staples are outperforming and that staples are underperforming and that tech is outperforming. We ticked back up a little bit on Friday, but we want to see this ratio continue to decline to stay positive. That means tech is outperforming. We look at 1 to 3 month T-bills, which is cash, and we compare it to 3 to 7 year bonds. Now, this is coming down, and we're kind of chopping around right now. What we want for this to be more positive is this ratio to continue to decline. That means that there's not the interest rate concerns and inflationary concerns, but we're still in an uptrend with this ratio. We want to see this continue to go down to the point where we stay below both of these lines, and eventually we see the blue line cross back below the red line. That would be more positive for the market. The reason this is on the positive side is it had been going up, and lately, for the most part, it's now been coming down. This is a very similar kind of study, except we look at 1 to 3 year bonds versus 3 to 7 year bonds. We want to see this continue to drop below the rainbow. That would be more positive. This is tips to the 7 to 10 year bonds. This has also been coming down, and then it's spiked up a little bit. We want to see this ratio continue to decline. That means that stocks are outperforming bonds and interest rates are actually coming down, and that is more friendly in the current environment that we're in. We look at a ratio between the S&P and the utilities. This is starting to go back up. That's positive. That means the S&P is outperforming. Staples to S&P 500 ratio continues to go down, even though it ticked up a little bit on Friday. We want to see this keep going down. That tends to be more positive for the S&P. The parabolic SAR, another primary indicator, when the dots are underneath, that's positive, and they continue to be so. And I showed the weekly chart a week ago. Just take my word for it. It's still positive. The dots are underneath that chart too. This is a little bit of a concern, but it's still positive. This is the bullish percent index, and this measures the point and figure buy or sell signals inside of the S&P. The fact that we're positive is because we're above 50. The warning sign that we're getting here is the S&P has been going up, but this has been chopping sideways. That's another negative divergence. We want this to keep going up to be more positive. Now, if we do see more declines in prices and this drops down below 50, that would turn this chart to negative. Here's the NYSE bullish percent index, also declining. That's the negative part. The positive part is that we're still above 50. And then we're looking at the momentum here. With the short term, we are looking positive, possibly a little extreme with the slope and the TSI. Then I have 3 intermediate term momentum oscillators, the MACD, the PMO, and the PPO. Those are continuing to be positive. We're also turning positive with our longer term TRIX and KST momentum oscillators. So that's still looking good. The vortex, another primary indicator. We have the green line on top and advancing. Even on a down day, this still went up in Friday's session. That's kind of interesting. Then we look at the cumulative advanced decline line for the S&P based on price, where it's been coming down and starting to go back up. That's the negative part, is that we were declining. The positive part is if you look at volume, we didn't really see much of a decline here. We're not going up, but we've been chopping sideways, even as this cumulative advanced decline line has been coming down. To me, that is a positive divergence, and we want to see more follow through with that. Large cap growth just coming off of setting a recent all-time high. The large caps are really outperforming the small caps, and they're just coming off of an all-time high with this ratio. The NASDAQ came right up to this R2 pivot point. These pivot points tend to be a big deal for the NASDAQ and NASDAQ 100. This was the overhead resistance, and we've not been able to break through this level, and now we're starting to come back down. Is this going to lead to more declines, or are we eventually going to be able to climb above this R2 level? The NASDAQ 100 did get above this R2 level, but it didn't stay there. It ended up getting above and closing above it, but then we came right back down. Is this going to lead to more declines, or are we going to be able to recapture that level and keep going higher? The momentum for the NASDAQ 100 is positive, but we are rolling over just a little bit. Here's the bullish percent index for the NASDAQ 100. We finally crossed above 50, so we've gone from being negative back over to positive. But there's a bit of a negative divergence here. The S&P was going up. we're seeing the bullish percent index actually lagging a bit. This is a broad market measure, the Wilshire 5000, just coming off of setting recent all-time highs. We're above the 50-day moving average, and the 50-day moving average is above the 200-period moving average. The total U.S. stock ETF just coming off of setting all-time highs and above all of the moving averages. This is as broad as I've been able to find as far as getting a measure of the overall stock market. So this is looking pretty good. The FANG index, Facebook, Apple, Amazon, Netflix, Google, and then NVIDIA and a bunch of other ones are in there. Just coming off of setting recent all-time highs. The SOX index, which is the semiconductor index. And I have some new things down here that maybe you haven't seen before. This has been the real backbone of the tech sector. It's just been going up, but now we're starting to see it pull back. Now, we're still positive because we're above the 50-day moving average, and the 50-day moving average is above the 200. We still have a ways to go to challenge that. Down below, we have the relative strength ratio. And when this is going up, that means the semiconductors are outperforming. When it was coming down, that means they're underperforming, and we're chopping around a little bit here. This other one, the green line, this is the momentum, where it had been falling back, starting to improve, but we saw a bit of a downtick in Friday's session. We also look at the tech sector. This is one of the stronger areas, just coming off of setting an all-time high. Both the relative strength and the momentum continue to be positive, and they're above this 100 level. So this is still looking really solid. We look at the tech sector and compare it with bonds, also above the rainbow and continuing to look pretty solid. Then we look, is the market anticipating a soft landing, meaning that we won't go into a recession, or a hard landing, meaning that we will go into a recession? We're still well above the rainbow, and this is going up for the most part, so the market is still anticipating a soft landing. This is comparing bonds with stocks. So what we want to see with this is this ratio continue to decline. That would be more positive for stocks. This is a long-term weekly chart of the NASDAQ 100 going back to 2009. We're above this trend line. That's positive in the longer term. And then I kind of like to make fun of the folks here. This is the NASDAQ 100 to the Dow ratio, where we hit a level back in 2000 and then just cratered after that. And then it took us many, many years to get back up to this. We hit this at the end of 2021 and then went into 2022. As we were coming back up, the perma bears, who I love to make fun of, if you look at the long-term action of the stock market, it tends to go up about 70% of the time, and it's down about 30% of the time. Well, these folks are bearish on the market 100% of the time, so it means 70% of the time they're going to be wrong. And no matter what evidence you throw at them, they just don't change their stance. They like to scare people. It's how they get views. It's how they get people to listen to their stuff. I don't believe in that. I'm not a perma bear. I'm not a perma bull. I like to be a perma realist. But now they're a little bit confused these days. I haven't been seeing too much speak about this chart from them, because we didn't only come back up to this red line. We're now breaking above it. It's like, well, we didn't really think that was going to happen. They thought this was the holy grail to the end of the stock market as we know it. Well, instead of it turning and going down, so far it's been continuing to go up. I'm sure they have some negative explanation for this, but they were looking at just this chart and saying everything was going to fall apart. But now that whole scenario has kind of changed. We're seeing a similar thing here with the QQQs, which is the NASDAQ 100 to the IWM, which are small caps, also breaking above this blue line. They thought we were going to hit this and just go in the toilet. Semiconductors to the Dow, they thought we were going to come up to this blue line, and we did once and started to fall. Oh man, they were getting all excited, those perma bears. But then they had to go back into hibernation because it started to come back up, and we actually have gone above the blue line. We look at the QQQs, the 3 to 7 year bonds. We're still well above the rainbow. We declined on Friday, but this is still looking quite positive. This is a broad market measure, the S&P 1500 to shorter term bonds. This is showing that stocks are outperforming. Then we look at another broad market measure and go further out, the 3 to 7 year bonds. This is still just looking really solid. Now, a week ago, this was on the negative side. I've changed it back over to the positive side because this is the S&P 500 equal weight. Now, this is a negative divergence. We have not set an all-time high here with this particular ETF, but we've been going sideways, and that's the negative part. The positive part is when we look at the equal weight QQQs, we haven't necessarily broken out yet, but we're coming back up to this previous high, and we went above this little shorter term high. So this is showing some improvement here. For this to be more positive, we want to see both the top chart and the bottom chart continue to go up. And we need interest rates to keep coming down. The 10-year yield had been declining, then it went back up, then it's been declining. We've been chopping around a little bit over the last few sessions. Now we look at some of the negative things. Sentiment. Because we're below 50, I put this on the negative side. Now, the S&P is right at or near all-time highs, and we're seeing sentiment going down. That's because of some of the negative divergences that we've been seeing, and a lot of things that are used to calculate all the different indexes that are used in this index, they're not showing any strength right now because it's a smaller group of stocks that are really leading the market higher. And that's causing the sentiment gauge to actually decline even when we're going up. So I had to put this over on the negative side. When we're going in this direction, we tend to follow that, but all of our charts are looking more positive right now. So we want to see if this can actually improve and start to go back up. Then we're looking at the S&P and the NYSE advanced decline line. A week ago, this was giving us a pretty strong negative divergence. The S&P was going up. That's the bar chart here. The red line was going down. That's the NYSE advanced decline line. We're seeing a little bit of an improvement here, but not much. We want to see this really start to improve and actually get to the point where it crosses back above the bar chart here. Even though they're different scales, this tends to be when we see more strength in the market, when the red line's above the bar chart lines. The NYSE McClellan oscillator, where the S&P has turned positive, it crossed back above zero. The NYSE McClellan oscillator, it's improving, but it's still below zero, so that's still negative. And so the summation index based on price and volume continued to decline. This is actually a little bit more negative. Where we've been going down based on price, we've been going down a little bit more on velocity based on volume. See how the line is shorter for price and it's longer for volume? Just something to be aware of. Where we're seeing more of a positive volume divergence when we look at the S&P, this is giving us more of a negative divergence. And when we look at the NYSE new highs minus the new lows, this is just a daily count. And this continues to be below zero. That's negative. What I also follow is the moving average. Now, we're still positive. It's going to take a while because this is a 50-period moving average. But the fact that this is negative, where it had been positive for pretty much all of 2024, that's giving us a little bit of concern. And then we look at a 5-period moving average of the highs minus the lows, and not just at the NASDAQ. We look at the Amex, NASDAQ, and NYSE together, and we're dropping down below zero, where we've been above zero for most of 2024. The mid caps, which have been stronger earlier in the year, they can't even get above their 50-day moving average right now. So this is negative until we can get above this red line and close above it. And then what would make it even more positive is if we could get above this pivot point and close above that. But we have not been able to do that yet. And we're still seeing pockets of strength and a lot of pockets of weakness here. This is the advanced decline line studies. We're below the moving average with the NYSE common stock, but we're showing a little bit of an improvement. This is the positive side of it here. The S&P was able to cross back above the moving average. Even though we're improving with the mid caps, we're still below the moving average. We're flat with the small caps and also below the moving average. Then this is the ratio between the S&P 500, which is a weighted index, and then the equal weight S&P 500. When this is really going up, that means that just a few of the really big stocks are controlling the market. Now, that could be positive or that could be negative. We would like to see what we were seeing earlier in 2024, where this ratio really wasn't going anywhere. That just means there's more broad market participation. And my view is, yeah, this is good and this can really send things higher. But what if there's some profit taking? What if something happens to those stocks that have been holding the market together? It'd be nice if we had more participation by other stocks. And the financial sector kind of, it was showing some weakness. It's been able to come back up to its 50-day moving average, and it's still in an uptrend, but we want to see this actually go above the 50-day moving average. We're also keeping an eye on the ratio between the financial sector and the S&P, where the financials have really been underperforming after they had been outperforming. Now we're bouncing back up a little bit here, but we want to see this really continue to go up the way it was in late 2023 into the earlier part of 2024. and that can usually give more support to the market. And we look at home construction. This had been holding up very well above the rainbow. Now we're starting to fall into the rainbow, and the rainbow's starting to roll over. This is a very interest rate sensitive environment. So the fact that this is going down is giving us some concern. And we look at the Eurozone. Now, some of that's geopolitical because they were having some problems in France with the election, and they're going to leave the EU and blah, 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 blah. And that's affecting more of the EU markets than it is the American markets. So the Eurozone itself, ETF, has been going down while American bonds have been going up. And that's why we're seeing this ratio going down. We want to see if this is going to continue. Now, this past week, the European markets stabilized a bit. We'll see if they can continue to stabilize, in fact, even bounce a little bit higher. Then we look at the staple sector, where when you look at this by itself, this is in a solid uptrend. This is a more defensive area of the market. When this is really going up at the end of 2021, this is what happened when we went into 2022. That's the negative side. But then if you look at the bottom, you look at the relative strength and the momentum, they're actually below this 100 level and declining. So they're showing a little bit of weakness. We want to see that continue. Now, staples can still go up and the market can still go up, but we want to see discretionary doing better, not necessarily staples. And we look at utilities. Is this just profit taking after they were almost parabolic going up? They've come back down to their 50-day moving average. We're also seeing the relative strength and the momentum continue to drop below 100 here. Are they going to bounce up off of their 50-day moving average, or are they going to continue to fall? The reason why we're watching this is they were really strong right at the end of 2021, and then they stayed strong into 2022 when the market was really having some problems here. So we want to keep an eye on this. Now, there's been some points brought out that maybe this has to do with AI. AI has been around this whole time, and it wasn't, we were seeing a lot of weakness back in 2023 in the utilities, and AI was still here. So I don't know. I don't know. I just look at the charts and I go based on what we've already seen in the past. This is just an area that we want to keep an eye on. And this is also a bit of a concern. This is a weekly chart of the QQQs, which is the NASDAQ 100. You see where we were up on the week and we set an all-time high, but we went up to the top and then we closed down here at the bottom. Is this some kind of a longer-term reversal that's happening? We don't know yet. We can just see that we opened and closed just about at the same point, and we closed at the bottom of this weekly bar. That could be a little bit dangerous. We just want to keep an eye on that. And the last chart is looking at the dollar. The fact that it's in an uptrend, both on the daily chart and then, take my word for it, on the weekly chart, that can put pressure on stocks as the dollar continues to go up. Stocks like a weaker dollar. Thank you. I really hope you found this video helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.